Welcome to PyUncut, where we break down the biggest stories in technology, finance, and markets in a simple and engaging way. Today's topic is one that has caught the attention of investors around the world. One of the largest banks on Wall Street has issued a bold warning about Tesla, suggesting that the stock could fall as much as 60%. That is a massive potential decline for one of the most talked about companies in the world. So what is really going on here? Is Tesla truly in trouble, or is this just another example of Wall Street being too pessimistic about a disruptive company? Let's break it down step by step. First, let's understand where Tesla stands today. Tesla is not just a car company. It is often viewed as a technology company, an artificial intelligence company, and even a future robotics leader. This narrative has helped Tesla achieve one of the highest valuations in the entire stock market. At the time of this analysis, Tesla is trading at a very high valuation compared to traditional automakers. Its price-to-earnings ratio is significantly higher than companies like Ford or General Motors. This means investors are not just paying for what Tesla is today, but what they believe it can become in the future. And that is exactly where the concern begins. The warning from analysts is based on the idea that Tesla's current valuation may be too optimistic. In simple terms, the stock price assumes very strong growth for many years ahead. But what if that growth slows down? Let's talk about the first major risk: slowing demand. Tesla has already captured a large share of the electric vehicle market in many regions. But the global EV market is becoming more competitive every year. Companies in China, Europe, and even legacy automakers in the US are rapidly expanding their electric vehicle offerings. This means Tesla is no longer the only game in town. If competition increases, Tesla may need to lower prices to maintain market share. We have already seen this happen. Over the past year, Tesla has cut prices multiple times across different markets. Now here is the problem. When prices go down, profit margins also go down, and Tesla's margins have already started to shrink. The second major concern is profitability. Tesla used to have industry-leading margins, which was one of the key reasons investors were willing to give it such a high valuation. But as price cuts continue and competition increases, those margins are under pressure. If Tesla's margins start to look more like traditional automakers, then the justification for its premium valuation becomes weaker. And that could lead to a significant correction in the stock price. The third issue is execution risk. Tesla is working on multiple ambitious projects at the same time. These include autonomous driving, robotaxis, AI systems, and even humanoid robots. While these projects have huge potential, they are also uncertain. For example, full self-driving technology has been promised for years, but it is still not fully realized. If these future technologies take longer than expected or fail to deliver at scale, investors may start to lose confidence. And when expectations are very high, even small disappointments can lead to big stock moves. The fourth factor is macroeconomic pressure. Interest rates are still relatively high compared to the past decade. Higher interest rates tend to reduce the value of growth stocks, especially companies like Tesla that are valued based on future potential. In addition, consumer demand for big-ticket items like cars can slow down during economic uncertainty. If the global economy weakens, Tesla could face both lower demand and lower pricing power at the same time. Now let's connect all these dots. When analysts say Tesla could drop 60%, they are not necessarily predicting a collapse of the company itself. Instead, they are saying that the current valuation may not be sustainable if growth slows, margins shrink, and future expectations are adjusted. In other words, the stock price could fall even if Tesla continues to grow, just not as fast as investors expect. This is something many investors often overlook. A company can be successful, innovative, and growing, but its stock can still go down if expectations were too high to begin with. Now let's look at the other side of the argument. Tesla bulls believe that the company is still in the early stages of a much bigger transformation. They argue that Tesla is not just selling cars, but building an ecosystem of energy, software, and AI-driven products. For example, Tesla's advancements in artificial intelligence and self-driving technology could open up entirely new revenue streams in the future. If Tesla successfully launches robotaxis or achieves true autonomous driving, it could fundamentally change its business model. Similarly, Tesla's work on energy storage and solar products could become a significant part of its growth story. And then there is the Elon Musk factor. Love him or hate him, Musk has a track record of pushing boundaries and achieving what many thought was impossible. From electric vehicles to reusable rockets, Tesla's journey has always been driven by bold vision. So the big question for investors is this: do you believe Tesla will continue to outperform expectations and justify its high valuation? Or do you think the risks are increasing, making the current price too expensive? This brings us to an important lesson for beginner investors. Valuation matters. It is not enough to invest in a great company. You also need to consider whether the price you are paying makes sense based on realistic future growth. High-growth stocks can deliver incredible returns, but they can also be very volatile. And when sentiment shifts, the downside can be significant. Let's summarize the key takeaways from this story. Tesla is still a leader in the electric vehicle and innovation space, but competition is increasing rapidly. The company's margins are under pressure due to price cuts and market dynamics. Future growth depends heavily on successful execution of ambitious projects, like autonomous driving and AI. Macroeconomic factors like interest rates and global demand could impact performance. And finally, the stock's high valuation means that even small disappointments could lead to large corrections. So what should investors do? The answer depends on your investment strategy. If you are a long-term investor who believes in Tesla's vision and innovation, short-term volatility may not matter as much. But if you are focused on valuation and risk management, it is important to be cautious when expectations are extremely high. In the end, Tesla remains one of the most fascinating companies in the world. It sits at the intersection of technology, energy, and artificial intelligence. But as this warning highlights, even the most exciting companies are not immune to market realities. And sometimes, the biggest risk is not the company itself, but the price investors are willing to pay for its future. That is it for today's episode of PyUncut. If you found this breakdown useful, make sure to stay tuned for more deep dives into the stories shaping global markets. See you in the next one.